for banking shareholders, how would you think about, I guess, the value of banks?
Yeah, well, it's a really important question. I mean, ultimately, if you're running one of these companies, you're running a big public company. You got to think about that. So I tend to have always thought about it as a long-term thing. I was a management consultant in banking, and we used to do a lot of our work was around how do you value banks, how do you generate value. What I came to believe is at one level there's a fairly simple formula for valuing a bank, which is that the market to book ratio of the bank is equal to the return on equity minus the growth rate divided by the required return minus the growth rate. I'm assuming people are kind of into this stuff in your listenership. And so there's this ratio. Basically what that says is the higher the return is relative to the risk, the higher the premium you get in your market to book ratio. And that tends to work for banks kind of everywhere. Now, when you peel that apart, what that is really saying in English is that the value of the bank, when you break it down, the dividends are a relatively small percentage of the value that people attribute to the shares of a bank. So I used to, when I was talking to our staff, I'd say, look, if you buy a share of Westpac stock, the dividends that you earn on that over the next 3 years in total might add up to about 15, 16, 18% of what you're paying for the stock. So what that really says is that 80, 85% of the value is in the future. Now, what drives that value in the future? Well, you go back to the formula that I talked about. It's essentially about, can you drive up the return on equity relative to the risk that you take? And can you grow the book value of the company? Okay, so that's still a bit mathematical. If you turn that into plain English, what you're really saying is, why would you have, to get a higher return, people need to be willing to pay you more than the commodity rate for something. So why would they do that? Well, they would do that because the service is good, they value the brand, and the like, right? And why would they stay with you longer? The growth rate is going to be new people joining you and people staying with you longer. Why would they do that? Because they value the service that you're giving them. You're finding ways to add value to them over time. So what I used to say is, so therefore, if most of the value is in the future, and most of the future value is driven by the quality of the service that you're providing, there is no conflict between doing what's right for customers and doing what's right for shareholders. And to me, that was a really important thing. I had to, just the way my brain works, I had to get that working in my brain mathematically to kind of prove to myself that actually doing the right thing was actually doing the right thing. And I think a lot of people perceive, and now there are a lot of people who call themselves investors who in my mind are traders. And I make that, and I took the view that I'm running the company for investors, not for traders. And now the traders, and you can make money being a trader. You can, there's lots of analysis where in the Australian banking market, you can trade in and out of bank stocks because everyone holds some bank stocks, but you can, the next 6 months, this one's doing better than that one, and people trade in and out. But I've always took the view that I can't control that. What I can control is building the long-term franchise value of the company, and that's going to be driven by the quality of the brand, the quality of the service, and your efficiency, your ability to turn revenue into profit by managing your costs well. That's it. So I don't know if that's helpful, but in my mind, it's that the big insight for me, which I always try to reinforce to people, is that this notion when you're running a public company that you have a choice between doing what's right for customers and doing what's right for shareholders, I think that's wrong. I actually think it's mathematically wrong.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.